Hello all, welcome to this new EnergyScan webinar session. We are going to wait 1 minute to let more people coming in. So welcome to those who just joined. It's now time to launch the first EnergyScan webinar session of 2025. I'm Julien Waro. I'm in charge of the economic research team here at ENGIE Global Energy Management and Sales. And it's not too late to wish you the best for this new year, which started in a busy way for energy markets. Wholesale energy prices remain volatile and globally oriented on the upside since the beginning of the year. So the second term of Donald Trump has already sent shockwaves throughout the global economy and keeps significant uncertainty regarding ongoing geopolitical issues. Europe and the US also went through cold periods this winter so far, and market players keep a concerned eye on quickly depleting gas stocks in Europe, notably after the end of Russian gas transit through Ukraine. Finally, despite a further drop in power prices across Europe last year, electricity demand is still weak and below pre-crisis level in a very uncertain macroeconomic context. So in this session, we'll give you the key elements to understand the outlook for the coming months with our speakers, Olivier Gasnier for the macroeconomy and the crude oil part, Évariste Nouki for the gas section, and Luc Ruffier for power and carbon issues. So as usual, check out the buttons on the bottom right corner of your screen to ask questions to our speakers or chat with participants and leave suggestions to the team. We'll do a Q&A session at the end of each presentation. And I remind you that this session will last 90 minutes to take as much questions as possible. Finally, you will also be asked to fill a one-question satisfaction survey at the end of the session. So the slides and a replay of the session will be available by tomorrow at the latest on the EnergyScan platform. But you can already download the slides by clicking on the cloud icon on the top right corner of the screen, or you can follow the instruction displayed here. So let's move on to the first part of this session with the macroeconomic and crude oil outlook with Olivier. So let's start with a one-question poll on one of the main threats brandished by Donald Trump over the past few weeks and months, the possibility of a trade war. So do you think that there will be a trade war between the USA and its neighbors, so Canada and Mexico, the USA and China, the USA and the EU, or there will be no trade war? So thanks to those who to take part to the survey. So we can see that we have first rank a trade war between the US and China, close to 50% of answers, followed by the US and the EU, then the US and Mexico, and finally very few answers regarding the absence of a trade war. So the outlook will be quite interesting to analyze. So I'm closing the poll. Olivier, so the floor is yours.
Yes. Hello, everybody. Thank you, Julien. So it's the start of the year. Happy New Year to everybody. It's the time for thinking about what might happen this year. And we have a very special start to the year with the arrival of Donald Trump at the head of the US. He promises profound changes both for the US economy and society. and also for relations between the US and the rest of the world, including the US main trading partners, with the threat of trade war, as we have just seen, and including also changes for the US main allies. And one might be tempted to say that it will be especially the case for the close allies of the US, its neighbors, Europe as well. Since November, and even more so since the start of the week, this has been really everything about Trump, and this presentation will be in a way no exception. So I would be tempted to say welcome to 2025, and welcome to a world full of uncertainty. So to start, contrary to what Mr. Trump is saying, the US economy is doing well. So you can look at the first graph on the left. GDP is widely criticized as a benchmark for the economy's good health, but there is no really replacement solution, replacement criterion. So we are going to keep looking at it. And you can see that since before the COVID crisis, the US outperformance in terms of GDP growth has been around 7 points versus the Eurozone, or 10 points versus the Japan or UK. Of course, there is a wide underperformance against China, but first, you can really doubt about the reliability of Chinese statistics. This is the first point. And especially the case that China has posted a 5% growth in 24. And the second point is that China, of course, is still in a catch-up phase. If you look at the GDP per capita numbers for the US, the GDP per capita is at 76,000. For France, it's 58, and for China, it's still much lower at 23,000. It's normal to have stronger growth in China. If you look at the economic prospects at the start of this year, I have taken this indicators, the services PMI, the purchasing manager indices. These are the main leading indicators today. They are consistent between countries, so that allow comparisons. And you can see that services PMI, they mainly reflect the dynamism of the domestic demand. And for the US, it's really much, much higher than in other countries. And the gap has even widened considerably since Mr. Trump's election. So I would be tempted to say that while, of course, Trump is threatening other countries of a trade war, he is attacking weaker economies, actually. The consequence of this dynamism of the US economy is persistent inflationary pressures. I would say that the original scene of this, to find this, you have to go back to the 2020 election. There was successively the last Trump stimulus plan, and then the first Biden stimulus plan. And so the savings buffer for households increased from around $850 billion to a total of $2,300 billion at the end of 2021. So this has, of course, allowed a fall in the savings ratio of households, and that has supported by consumer spending by around 2 points per year since 2022. So it's really a massive support, because that represents an addition of 1.2% of GDP growth each year. And as you can see as well on the graph on the left, the excess the savings accumulated by US households during this period is not empty, and that could support consumer spending for another 2 years if you add to this that the economic program of Mr. Trump is the renewal of the tax cut implemented during his first mandate. He plans also further corporate tax cuts or deregulation plans in many sectors. The situation is very healthy at the moment with full employment, etc. So everything is in place, I would say, to continue to fuel inflation. And we have seen some worrying indicators recently, such as the ISM survey in services. ISM is the equivalent of the PMI. It's a Purchasing Manager Index, but it's much older in the US. And you can see also the price component in services that has been traditionally a good leading indicator of core tensions in prices. And the last point was especially worrying. We'll see if it's confirmed when it's released in the coming days at the start of February for the month of January. The last graph is also interesting. It shows a constant acceleration in inflation expectations. This is the University of Michigan survey. So this is a consumer survey. And the question is about the 5 to 10 year inflation expectations. And you can see that, of course, there is volatility, but there is a clear upward trend. And this is quite a worrying factor, especially for the Fed, that looks at the fact that inflation expectations remain anchored. Yes, the situation, I would say, is still quite worrying at this stage in terms of inflation in the US. The consequence of that is higher interest rates. What we have seen is really unusual since September. In September, the Fed started cutting rates by 50 basis points, saying at this time that they had the feeling they were lagging behind, actually, and they feared an economic slowdown that would be too marked. And so this is why they decided to cut interest rate not by 25 basis points, but immediately by 50 basis points. And after that, they have cut rates again in November and then in December, so for a total of 100 basis points. But at the same time, we have seen bond yields increasing by around the same amount, I would say, plus 100 basis points on the 10-year bond yield. So this means that the market had really big doubts regarding the Fed move. They were really confident at the start that the Fed was right, and they were expecting very numerous rate cuts in 25, as you can see on the graph on the middle. At that time, the market expectations were that the Fed would cut rates by 6 to 7 times in 25. Now, the current expectations are that the Fed should maybe proceed to another rate cut, maybe 2, but it's not certain at all. So big upward revision in Fed rate expectations due to, of course, the strength of the US economy, the fact that core inflation has remained rather high at more than 3%, much above the 2% target of the Fed. And of course, the fact that Donald Trump has been elected with a program that is considered as being inflationary or more inflationary than that it would have been the case if Kamala Harris had been elected. So the Fed announced in December that they would mark a pause. So now waiting for a real fall in inflation, not only expectations that the disinflation will continue, and we can expect that this pause could last. The impact on the bond yields, so we have already seen that there was an increase in US bond yields, but it has been also accompanied by an increase in bond yields in the UK, in the euro area, even if there are prospects of further ECB rate cuts or Bank of England rate cuts. So this is really linked to the situation where everybody thinks that there will be inflationary tensions. There are there is this threat also of trade war that could also fuel more inflation. There is the fact also that the Bank of Japan is increasing its interest rates. It's a kind of normalization of its monetary policy, and they should increase rates tomorrow. And the big exception is really China, where you have first a market that is rather closed with still capital controls, and also the fact that there are clear deflation threats in China. China is really in a world apart, in a world of inflation. China is threatened by deflation. So, of course, we cannot continue without talk about Trump policy. I have put the main elements of his economic program in this table. So some measures have already been taken. Maybe in this table there is well, we could add deregulation in the banking sector, in the artificial intelligence sector. There is this joint venture between Oracle, SoftBank, and OpenAI that has been launched 2 days ago to develop a massive investment in infrastructure for artificial intelligence. There is also the support to cryptocurrencies, etc., etc. But of course, the main point of Mr. Trump program is about the tariffs, the fact that he wants to impose taxes on imports from its neighbors, from Europe, from China. And it was quite a surprise that he didn't announce anything concrete so far. That has surprised market. He has launched a kind of review of what has happened in terms of trade with China over the last few years, etc. He has clearly promised that it would impose tariffs of 25% on imports from Canada or from Mexico, 10% on Chinese goods from the 1st of February, but so far nothing concrete. We can think that there are negotiations underway already, and nothing has been announced at this stage against Europe. Still threats, but nothing concrete. Also, it's interesting to look at this map showing the trade relation between the US and its main partners. So main trade partners are Canada, Mexico, China, Japan, and Germany in Europe. It's interesting to see that the US first is a relatively closed economy. If you do the sum divided by 2 of the export plus imports and you compare this to GDP, it's less than 10% of GDP for the US. For example, it's nearly 17% for China, or more than 35% for Germany. So of course, it's not at all the same situation because of the big domestic market of the US. And you can see, of course, that it has it's very important. It's a key market for Canada or for Mexico. So he can impose a strong pressure on those 2 countries. But you could imagine as well that they could retaliate, and they could also take measures that could be a very big problem for the US. I think we will have negotiations and probably a deal between those countries, but it's not impossible that you have something very bad that is a result of this game. And if you compare also China to Europe, I would say probably China is in a better place because China has a wider diversification with trade with emerging countries, etc. So probably the main threat is on Europe and especially on Germany, which is really dependent on exports. There is also the problem of the strong dollar. We have seen the dollar climbing. I mean, really related to the evolution of the possibility of a trade war. Each time there is a worsening of the situation, the US dollar is increasing. You can see that with, for example, at the time right now, you can see a strengthening of the US dollar against the Canadian dollar or the Mexican peso. And you can see also that if you look at the evolution of the euro dollar versus the interest rate spread between the US and on Europe, there has been a widening, which shows that there was a clear effect of this intensification of threat against Europe by the US. This has been a bit corrected over the last few days, but the dollar is very strong, whereas Trump would like it to fall to boost US competitiveness. So this is really a contradiction. There has been reports about a possible kind of Mar-a-Lago agreement, which would be a kind of bis repetita of the Plaza Agreement in 1985. But I think it has no sense because you cannot imagine today with the situation of the European or Chinese economy that they would raise rates to lead to a strengthening of their currency against the dollar. Also, there is the risk that if they start selling treasuries, given the large US deficits, that could really trigger a kind of negative spiral. So I don't think it will happen. And this strong dollar can be a problem for emerging country because when you have a strong dollar, you have a problem of capital flows that are slowing down into this country. These countries are forced to increase their interest rates or to intervene on the FX market to defend their currencies. So it's not a healthy situation to have this very strong dollar for a long period of time because it increases the risk of accident in the emerging world. Now to finish, I would like to say a word about the oil market, of course. There has been a downward trend until September that was mostly linked to weak demand in China in particular, with disappointment regarding the potential recovery in Chinese demand, and also the fact that OPEC Plus has restrained its production and again and again, and that has supported the prices. There has been a rebound recently, which was mostly linked to cold weather in northern hemisphere, and as well to new sanctions against Russia. But overall, you can see that there has been no break in the trend regarding the evolution of Brent linked to the Trump election. This is quite remarkable. Why? I think because he is pursuing contradictory targets. He wants to boost U.S. Oil production, but at the same time, he wants to impose more sanctions on Iran or even Russia. So an increase in output, a decline in output, or a decline in exports on the other hand. He would like low oil prices to support the U.S. consumer, but he wants at the same time to rebuild U.S. strategic reserves to the top, he said. So here again, some contradictory announcement. When you look at the evolution of demand potential, you can see that there has been a trend of downward revision in forecast for world oil demand in 25 compared to 24. And you can see more precisely, because this is a key factor, that the evolution of Chinese import of crude oil shows something rather stable. Actually, there has been a fall linked to the COVID crisis, a recovery in 23 that probably gave a false impression that this trend could continue, but in 24, just a stabilization, and there is no real prospect of acceleration. First, because China is producing a bit more. And a second impact, of course, is the accelerated replacement of thermal vehicle by electric vehicles. On the supply side, first, you can see that the US is the main world producer. There are large available capacity for Saudi Arabia, but now the US oil output tops 13 million barrels per day, while for Russia or for Saudi Arabia, it's around 9 million barrels per day. So you cannot really say that there is a state of urgency in the energy sector in the US. Second graph to show that the OPEC plus countries, so OPEC plus Russia, say, plus other countries, they have decided to increase output from April over a period of 18 months, so until September 26, by more than 2 million barrels per day. And for this year, it would be around 1.5 million barrels per day, so more than the expected increase in global demand. The big unknown, even if Trump has threatened Russia with more sanctions, is Iran. He has announced nothing about Iran, but you can see on this graph that with the war in Ukraine and to ease tensions on the oil market, US and its allies have allowed Iran to export more. That could be put into question if there were new sanctions against Iran. So this is probably the main threat against for a contraction of supply. And there are additional questions because you can imagine that with large capacity from Saudi Arabia in particular, they could easily replace the missing Russian or Iranian output. But there is also the agreement of the inside the OPEC Plus between Saudi Arabia and Russia, and there is also the normalization of relations between Saudi Arabia and Iran that have started. So it will be more a political decision if there is a lack of production and export of these two countries for Saudi Arabia to replace or not those missing barrels. In terms of supply and demand balance, you can see, but what is important is to look at the evolution of the stocks on the bottom of the table. Second half of 24, the market was in deficit of supply, so that supported prices. Now we are switching into an excess supply, an oversupplied market, even if you take into account the fact that there are new sanctions against Russia, etc. And even if OPEC Plus decided not to increase the output, the market will remain rather oversupplied. So this is clearly a bearish situation for the market. The fundamentals are bearish, and that would normally be followed by a downward adjustment in prices. Okay, so I have this is the end of this part on this presentation on macro and oil. Just the key points to have in mind. The fact that the arrival of Donald Trump probably exacerbates the contrast between a healthy US economy and the economy that are not in a good shape, Europe and China in particular. There are still inflationary pressures in the US, and this is likely to keep interest rates very high almost everywhere. And that will make the easing of monetary policy in Europe in particular ineffective. as the ECB cut rates, but long-term interest rates remain high. We think that the US is in a rather strong position of trade negotiation, but there are risks of negative spiral. You cannot exclude that. As I said, the strong dollar is not just a problem for US competitiveness. It can be a big problem for emerging countries as well if it lasts. And the fundamentals remain bearish for the oil market. But of course, you have still a risk associated with geopolitical tensions regarding what the US will decide over Iran in particular. Thank you for your attention. Julien, do we have some questions?
Yes, Olivier, thanks for this exhaustive view on the macroeconomic landscape. So we have 2 questions from the chat room, especially on Donald Trump. First question, is the mass deportation of illegal immigrants not going to cause issues on the employment market in the US?
Yeah, from an economical point of view, I mean, I will stick to that. It's a clear risk of to add inflationary pressures because, of course, in many sectors, you can face situation where you lack employment. This is not you can not easily replace the people who would be sent back to Mexico or everywhere. I mean, I think it will be complicated, and that won't probably happen easily. But yes, this is a risk for to add inflationary pressures to the US economy.
Second question, once again on these inflationary pressures and the link between Donald Trump economic program and the Fed. So could Trump's inflationary program have an impact on the Fed's goal of reducing inflation?
Of course, I think this is one of the reasons, because the reason for deciding a pause in interest rate cuts. I mean, they have said, okay, we don't see inflation falling, so now we'll wait for this happening effectively. But another cause is probably the uncertainty regarding Mr. Trump economic program. And now also there is the question of the independence of the Fed, because of course very quickly Mr. Trump will put the pressure on the Fed to cut rates, nevertheless, even if inflation is strong. And we have seen, for example, one of the key Fed members, Mr. Waller, who had been nominated by Trump during his first mandate. He was really a hawk until the end of the Biden mandate. And now he says that the Fed could cut rates several times this year, etc. So it shows that the risks to see a direct influence of Mr. Trump, the new administration on the Fed, is not low. In 26, the Mr. Powell will be replaced, and there will be a new Fed president, and will be probably more favorable to Mr. Trump. So I think this is a clear risk to have a kind of loss of independence of the Fed under the Trump presidency.
Okay, thank you, Olivier.
Thank you.
Let's move on to the gas part of the presentation with Évariste, and as usual, a small poll to you regarding the gas market. So I'm going to publish this poll. So back to prices, to wholesale gas prices. TTF spot prices average 34.4 euros per megawatt hour in 24. They were above 40 euros per megawatt hour in 23. So what is your guess for their average level in 2025? Is it between 20 and 30 euros, between 30 and 40 euros, 40 and 50, or between 50 and 60 euros per megawatt hour. So it's quite clear in terms of trend between 30 and 50 euros per megawatt hour overall. I would say around 40 euros per megawatt hour, which on average is above last year's level. So overall, a relatively bullish view from the audience. So let's see with Evariste if you agree and if you have elements to complement that. Thank you, and the floor is yours, Evariste.
Thank you, Julien. I hope so. I hope I have some elements. Hello, everybody. My best wishes to all of you for this new year. A year full of uncertainty for the European gas market after the halt of Russian gas flows via Ukraine. And for sure, now the European gas market has to find a new equilibrium. To understand what is at stake, we can just start with the balance. The balance first, you can focus on the year-on-year change. When you look at the year-on-year change, you see that we had rather good news. Increase in Norwegian flows, increase in Russian flows as well. Of course, we had this drop in LNG supply, but this was expected. And on the demand side, demand was not so strong. If you want to look at the change in percentage, you have the comments on the right. In particular, when you look at demand for power generation, it was down when you take the whole 2024 year. But then you can look at the quarterly change. When you look at the last column of the table, last quarter compared to the previous year, you see that for Norway, for instance, you had some technical outages that reduced supply from Norway. But the major changes, you have them on the demand side. If you take local distribution zone demand, mainly residential and commercial, you see that the increase we had for the whole year was in fact concentrated on the last quarter. So the increase we have for the last quarter was very strong. And while in the previous quarters, demand was rather down, in the last quarter, demand was strongly up. And this is even more strong for power generation. For the whole 2024 year, power generation demand was down. But if you look at the last quarter, we were up. So what happened during the last quarter was clearly a rebound in demand, explaining the tightening of the European gas balance. And at the end, when you look at the stock change, you see that we end with stock levels at rather low levels compared to the previous year. Those for sure, there was a clear tightening of the European gas balance in the last quarter of last year. In terms of stock, you see the change there. You see the clear slope, downward slope in terms of stock levels, starting 1st of November. Don't forget that at the time we were saying that we reach the target set by the European Commission quite early, but then there was this clear deterioration of the situation starting mid-November. So we end the year with rather low levels, and we are starting 2025 again with rather weak levels, slightly below the average. Nothing worrying at this stage, you can say, but don't forget that bulk of these stocks have been filled with Russian gas via Ukraine. Now we have to replenish the stocks without Russian gas via Ukraine, because since 1st of January, there is no more Russian gas flowing via Ukraine as expected. Of course, the European Commission tried to be reassuring, saying that this was expected and that the European gas infrastructure can manage this situation, finding some non-Russian gas from other origins, of course, and sending supply to Western European countries. For now, there is still some Russian gas flowing to Europe via the Turk Stream pipeline. One leg of this pipeline is sending gas to Western Europe via Bulgaria. But for missing around the 15 BCM of Ukrainian gas, you have to replace it via LNG. And the challenge is now, is Europe able to replace all those flows just taking LNG? Probably you also have to reduce demand to try to bring the balance at a more comfortable level. The market at the start of the cut reacted quite strongly. 2nd of January, TTF Monset prices reached 51 euro per megawatt hour, a quite strong level. But quickly thereafter, they drop. They drop because we'll see it later on. At the start of the year, Europe received higher LNG volumes. So the market was just saying that, of course, we miss some Russian gas, but if you can replace those volumes via LNG, the balance can still be comfortable. But thereafter, there was a set of factors that pull prices up again. You can see it clearly when you look at the graph on the left and even on the right for the calendar contract. What are those factors? First, you can imagine that the new sanction decided by the United States, they have an effect. Of course, you have some impact on Russian LNG terminals. These are not major terminals, but you also have the impact on oil prices because oil was much more hit by this decision. And oil is still relevant for the gas market, particularly in Asia. So high oil prices tend to increase the willingness to pay of Asian buyers. So this is the first effect. You can also imagine that the issues we are now seeing in the US LNG terminals, we'll see the flows thereafter. They have an impact. The last impact that occurred two days ago was the decision by the German market manager, THE, about the storage filling. So we put this chart to make a focus on this one. Remember, tightening of the European gas balance at the end of the year. So meaning that the market was seeing stocks depleting. So the market obviously was imagining that these stocks, you have to fill them by taking more summer gas. So it's not a surprise to see summer prices increasing. But what was surprising for the market was clearly that the spread, the summer-winter spread, moved to positive territory. So from a storage point of view, this is not normal. This is just sending the message that there is no incentive to buy summer gas and put in stocks and hoping to take it from the storage into the winter. The spread was not giving the right incentive to inject into stocks. Probably this explains why THE decided to give a subsidy. What they decide to do is clearly a kind of subsidy to market operators to give them the incentive to inject, although the spread is not giving this incentive. This lent support to the summer price. Obviously, you can see it from the graph. Is it sustainable? We don't know yet. We'll see later on by analyzing the fundamentals that to understand if this spread can be sustainable. And the first element is clearly to look at what will happen on the LNG side. Starting with supply. The good news on the supply side is that in the US, supply is expected to increase. At the end of the year, the Plaquemine LNG terminal entrance service, for the whole of this year, when you take the forecast given by the Energy Information Administration, they expect US LNG export to increase by 21 BCM, pulling total export to 145 BCM. Bulk of the increase obviously will come from Plaquemine. And you'll have an additional increase again next year. So structurally, the US LNG export will continue to increase. And you can easily imagine that with Donald Trump now being the president, this trend should continue. because its energy policy clearly is likely to lead to an increase in US oil and gas production, which is already at rather high levels. On top of that, Donald Trump ordered a reversal of the pause decided by Joe Biden. If you remember, Joe Biden at the start of 2024 decided to make a pause on the approval of US LNG terminals, just to see what could be the impact of a further increase the environmental and economic impact. This is now offset by the new policy, and you can imagine that you will have more approval for US LNG terminals, thus increasing the structural trend in this supply. But beside this structural trend, you have also to take into account the short-term factors. Recently, due to cold weather in the United States, some LNG liquefaction plants lack power. So they were not able to continue to operate. Think about Freeport, for instance. So they reduced their LNG production. You can see it when you look at the graph on the left, with US LNG export at the start of the year up, thanks to Plaquemine, and then a slowdown just because some terminals are having problems to continue to operate. Of course, this also impacted the total LNG export on the graph on the right. This is for supply. But you have also, Europe has also to care about competition on the LNG side between buyers. And the main buyer on the LNG is clearly Asia. Is Asia prepared to give up some LNG cargoes to Europe? This is the main concern for the European gas market. In a period, we have to replace the missing Russian volumes. At the start of the year, at the beginning of the year, Asia LNG imports were below the previous year's level, enabling Europe to have more LNG. But if you look at the graph carefully, the European graph on the right, you see that mid-Jan, we had a drop in LNG import. We'll see that this was due to the evolution of the spread between the two markets. Just to say that this volatility means that Europe will have to be careful about the level of competition on the international market just to secure its LNG volumes. If you are not ready to pay the price and others are ready to do so, you could be in trouble. And you can see it when you look at the netback of US LNG, either to Europe or to Asia. When you look at the orange line, which gives the spread between the two, you see that at the start of the year, clearly the netback switched in favor of Europe. It was negative, meaning that there was an incentive for US LNG exporters to send their volumes to Europe. And then when European prices dropped too much, the netback rebounded again. And it was precisely at that period that we started to see a weakening of LNG imports in Europe. Now, at the end of the graph, clearly, Europe is clearly more rewarding for European for the US LNG exporter, meaning that just in this point of view, Europe should have more LNG, but then you have to be careful about supply. If you don't have enough supply coming from the US just because in a very short-term period you have some outages due to weather or other factors, you can still receive less LNG just because of these issues on the supply side. So we talk about the increase in LNG supply coming from the US, but this is not, the US are not the only country that is increasing LNG supply. You have LNG supply expected to increase in some other countries. You can have Canada and so on. Here you have the values given by the International Energy Agency. Last year, the increase in LNG supply was rather moderate, only 10 BCM in terms of capacity. This year, we should have more, 30 BCM. Remember what I say about the US? Bulk of the increase of these 30 expected BCM will come from the US. And then starting 2026 up to until 2028, you'll have a bigger increase, as you can see it on the graph on the left. This is on supply. When you look at on the demand side, because the International Energy Agency also gives some outlook for demand, with three scenarios. There is one scenario, the first one, our business as usual, where demand is expected to rather be stable in some countries like China and even to drop globally. In all the three scenarios, demand is expected to drop. What does it mean? It means that for the gas market, the period of tightness is clearly expected to be this year, but starting next year, the global market should be much more comfortable because of supply, but also because of a weakening in demand. Let's now finish the fundamental point of view with our scenarios. The scenarios are built starting with the stock levels at the end of last year. Weaker volume compared to what we expected, of course, because of the tightening I mentioned at the end of last year. We make we assume that for some supply components like Norway, the expected remaining Russian supply, domestic production, North Africa and Azerbaijan, there is little uncertainty about this supply. So we assume that they should be around, you can fix them. And then you can focus on demand and also on LNG supply. With the three usual scenarios, now I guess you are familiar to those scenarios. We believe that scenario 2 and 3 are the most likely. They are the most likely. In this scenario, demand is rather moderate. We are not at the high level of around, let us say, a little bit below 400. We are the demand being stable or even slightly falling. LNG supply, of course, as we are missing Russian flows, you cannot assume that you will receive the same volume. So in the base case, we receive for Europe around 134 BCM, just to replace Russian volumes. And then you can even increase the flows by 5 BCM more if Asia is not taking those volumes. But in summary, we believe that ending with stocks level around 66 or 79, these are the most likely scenarios. And even in these scenarios, if you compare them to the stock levels at the end of 2024, you see that we'll be at that level or a little bit below. So the main message is to say that it will be difficult for Europe to end the year with higher stock levels. It could happen. It could happen if Asia is taking much less than what we expect. But we believe that these are the most likely outcome for stock levels. Let's now focus on scenario 1. In scenario 1, you are in a situation where demand is very strong for several reasons. It could be weak renewable, weak hydro, or jump in demand because of cold weather. If this happens, we continue to believe that countries like China and India will not accept to pay high gas prices. So they have one option, which is coal. And if this happens, I expect them to reduce their LNG imports and switch to coal, for instance. But you cannot also have another problem. You can see China or India reducing their LNG imports, but if you have a rather strong drop and durable drop in US LNG export because of the factors I already mentioned, the market can still be in a tight situation and maintain prices at high levels. Is it the scenario the market is pricing? We'll see it. From the audience, I noticed that at 40, you are not so far from my forecast. So here we put the forward curve versus our forecast. The forecasts are the one made in our monthly report released 1 week ago. So since then, the market price has increased, so the forecast is clearly below the current market price, but we still believe that they are relevant. And from what you believe, prices around 40 for this year, I see that you are not so far from what I expect as well for this year. So the tightness is for this year. Does it mean that prices should remain above the oil price, which is not a normal situation for the gas market? Clearly, this is a tight situation. I don't think so. I expect that at some point the market could come back to lower levels below oil, the Brent price, and starting 2026, thanks to a much more comfortable LNG balance, of course, you can see prices dropping below the Brent price, thus coming back to the more normal, more normal situation. And on the downside, you have to take into account the price of US LNG. It could be either the short-term marginal cost or the long-term marginal cost, where you add the liquefaction cost. So I think that in the years to come, the equilibrium of the gas market will be set by those levels. On the upper side, the Brent price. On the downside, the price asked by US LNG exporters. So that's it for the gas part. It was a little bit long.
Thank you, Evariste.
You have some questions for me?
Yeah, we have a lot of questions. We
okay.
try to address as much question as possible, but don't worry. If we don't address your question, we will take the time to answer it after the session. And just a reminder, the session will last until 11:30 with the power outlook with Luc just after that. So first question for you, Evariste. What are the most important bottlenecks for Europe to attract the necessary additional energy volumes during the next injection season? Is it competition with Asian markets, liquefaction capacities, number of available cargoes, or anything else?
I will say that you already answer all the elements that are important. Of course, you have to care about competition with Asia. You have to care about the liquefaction capacity, and I will say the utilization rate of the liquefaction capacity, because what we need is the actual volumes, not just the capacity. So the available cargoes, I'll say, I think they are enough. And on top of that, this is a point probably I did not mention, you have to care as well about US demand during the summer. It's not only in Europe or in Asia that you are now seeing a strong increase in power demand for cooling. In the US, you have a strong increase during the summer coming from power generators. If you have a hot summer in the US as well, you can see less volume, supply volume being available for liquefaction.
All right. So regarding the famous gas storages, do you expect those state-led gas buying, especially in Germany, this summer to help get to the 19% storage target by the 1st of November?
I will say this is a market. Huh? If you want to reach 90%, you will reach it. But the question is at what price? If you say I want to buy and to reach this target at any price, of course, somebody will be happy to leave you the gas at 100, 200. So I will say you have to put it in perspective with the price you are ready to pay.
One more question regarding Donald Trump. Of course, and the possible impact of a possible peace deal between Ukraine and Russia regarding Russian gas exports or imports to Europe. So in case Trump manages to get a deal, what does that mean for Russian gas imports?
If you have a deal, does it mean that we'll increase again our Russian gas import in Europe? I'm not sure, because some buyers, you have to accept to buy again Russian gas, given all what happened. And on the other side, even imagine you increase again Russian gas imports in Europe. This means that you will need less US LNG. I'm not sure that Trump will be happy to see that Europe is buying less US LNG just because he decided a policy that led to a peace between Russia and Ukraine. So you have to be careful about that one.
All right. Thank you, Evariste. It's time to move on to the power and CO2 section of the presentation with Luc. And as usual, a poll for you. So let me publish this one. And it's not a question about power, but about CO2 prices, which have been very strong in Europe over the past few weeks. And at the moment, the first EUA DEC contract, so the DEC 25 contract, is trading around 80 euros per ton, so much above the level we have seen only a few weeks ago. So at which level do you expect this contract to expire at the end of the year, in December 25? Will it be above 19 euros per ton, between 80 and 90 euros per ton, between 70 and 80, or below 70 euros per ton? So let's have a look at the first results. Close to 50% of answers between 70 and 80 euros per ton, then followed a third of the answers above 80 euros per ton, and finally only 10% above 90 and 10% below. So overall, a level not so far from the current level. And what could be the impact of this level on the power market? That's also a key question for the European market in 2025. So, Luc, the floor is yours for the last part of this presentation.
Thank you, Julien. Hello, everyone. Happy to be back for this webinar. So we're going to start with power. We're going to cover demand, supply, and prices, but there has been interesting developments on the demand side first. So first of all, if we look back at what happened in 2024, we've had a pretty interesting summer in terms of power demand, where we saw increasing power loads in Northwestern Europe, Southern Europe as well. But this trend faded early November and December, despite some slightly lower temperatures, especially in France. So overall, throughout the year, we haven't seen a dramatic rebound in power demand, despite already pretty low levels compared to pre-crisis levels. The situation is a bit different if we look at what's happening in different countries. Germany and France are, for instance, the biggest market in Europe, and they haven't been rebounding with lots of energy, let's say. France only increased by 0.5% compared to last year, Germany a bit more, but it's not a dramatic increase driving the whole continent's power demand to the upside. However, there are some interesting outliers. You can see that the Scandinavian countries, for instance, Norway is increasing pretty interestingly. Netherlands as well, thanks to strong EV penetration, strong heat pump penetration as well. So that's really something that could unfold later on in mainland Europe as well. There's an outlier, which is Ireland. where the power load of data centers is now greater than domestic residential demand. So, but it's interesting to look at, but maybe not likely to be very representative of what could happen in France or Germany, for instance. If we have a quick look back on what happened on the supply side in 2024, first of all, if we look at hydro, we had an impressive year, impressive 3 quarters actually, where we were basically setting records in terms of hydro output, thanks to very wet weather. This has had a strong impact on power prices. We're going to see that in the following slides. But this situation really faded in the last quarter of the year, where we saw a pretty strong normalization of hydro generation, which had some consequences on the power prices as well. Wind was about like close to our average in terms of normal throughout the year, up a bit above, a bit below, but no massive deviation until the last quarter of 24 as well, where October, November, and December were pretty significantly underperforming. And the last thing which is interesting to look at is nuclear generation in France, because over the past 2 years it has recovered dramatically, and even early January has set a record of you reached the 55 gigawatts of output, which was unseen since 2019. So that really shows how healthy the nuclear fleet is in France now, after the nuclear clashes we've seen in 21, 22, and 23. So on the first 3 quarters of the year, we've had strong renewables, which meant lower prices, and however, on the last quarter of the year, lower renewables. That means higher generation from gas and coal plants, because demand still needs to be covered, and that translated into higher prices. We're going to see that in a second. If we look at how this balance has shifted in Europe between supply and demand, well, first of all, as I already mentioned, the demand rebound is not significant. It's only it's close to 1%, and this increased demand has mainly been covered by increase in renewable outputs, mainly solar. The hydro overperformance is pretty impressive as well. Nuclear is outperforming thanks to the French nuclear fleet, and despite closures in 23 in Germany. And on the other side, that led to lower needs for fossil fuel generation to step in. So less coal, less lignite, less gas. So that's good for climate and also for power prices from time to time. And speaking about spot power prices, they really reflect the fundamentals. So the first 3 quarters were, you can see that power prices were pretty significantly below their fuel costs. So we even had a situation in Spain and France where we had strong hydro output, which really pressured the spot prices on top of grid constraints due to maintenances and a suboptimal allocation of grid capacity, let's say. But the situation resolved later around June, and then power prices gradually increased because fuel costs also increased. In summer, we even had a heat wave in August, which pushed power prices really high in Italy and also in Germany, where you still need gas assets to step in at the end of the day when there's a strong need for cooling, but no solar anymore. So there's pretty strong volatility on the spot price as well. And last quarter, no wind, or well, less wind, but some events with very little wind, which really sent power prices skyrocketing on some hours. And of course, the averages of spot price really really show that that some events, some weeks where you had very little wind, you had really high power prices. The next week, a lot more wind, so that you can really see the swings in power prices, which reflect the fundamentals. And those low wind events, often called Jungle float, have been actually pretty common this past winter. The first one was occurred in November 6th, where it's basically characterized by low wind and slightly colder weather, which stimulates power demand. And so on November 6th, you had less than 200 megawatts of wind output in Germany in the evening, so around 5. And so the only option for the grid is to switch on all the other generators which are available. So coal, lignite, gas peakers, diesel, fuel oil generators, and those come at a pretty pricey cost. And also, if you look at the geographic situation, if there's little wind in Germany, it's also likely that there's little wind in Netherlands, in Belgium, and also probably in France or neighboring countries. So the whole continent is short on wind. Everyone is trying to import for its neighbors. So when it's basically the shortest market that's going to be setting the highest price, and that was Germany for those events. Also, because of coal plant retirements that occurred in April 24. So we lost some backup capacity. We might lose a bit more in 25, around 700 megawatts. So yeah, it's raised questions for next year, especially if we think about an increase in power demand. Now, if we take a look at the calendar prices, so Cal +1 year calendar prices, they are still driven by short-term gas, coal, and carbon price developments. This is shaping really the day-to-day, week-to-week move. But within that, within those small trends, we see first an interesting development, which is that power prices are gradually decorrelating from fuel costs. So that's highlighted by the two red arrows. In early 24, we had power prices really close to fuel costs, while on January 20th, when I last loaded the data, we had a much greater discount of power prices compared to fuel costs. So that shows really the impact of renewables on power prices. That's great. But also, we see other developments. France has been putting a massive discount since June compared to Northwestern European countries. Spain is acting more as a support because he has strong wind, strong solar, and strong hydro, depending on the year. And yeah, for the French power prices, actually the situation is a bit amplified by some trading behavior. Let's say the end of the ARENH mechanism puts over 100 terawatt hours of nuclear output back on the market that EDF is trying to hedge at the highest price. And so there's increasing sell pressure for French prices, which can be artificially brought down. And you can see actually the spot, the location spread between Germany, which trended higher early January, and France, which traded lower early January, has increased. Now, if we try to think about how 25 could unfold, we need to think about how demand is shaped, how we could grow, and also on the supply side, what could happen. So first thing is on demand. Industrial activity, industrial demand is a huge component of power demand, but we haven't seen a rebound. We only have seen a decline actually in electricity demand from industrial sector because they are sensitive to power prices. in Italy and Great Britain, they have pretty high spot prices. They are linked to political context, economic activity. And again, Olivier and Évariste mentioned Trump, but that's also my turn to mention Trump. If we have a trade war with Europe and especially Germany, we could see also this sector shrinking even more. So it's to be monitored, but it's really if you are confident that we're going to see an increase in a growing European economy, then you could expect a growing additional electricity demand, and yeah, it's pretty gloomy for the industry in Europe. And even talking about decarbonation processes, it's being delayed. Basically, I have in mind ArcelorMittal, which delayed its green steel transition. So yeah, it could happen later in the decade. Two other big components for demand are heating and transport. So heating is mainly going to happen through heat pumps, which fall dramatically in 24. The sales almost half last year. That's a pity because there's a huge untapped potential for demand growth, especially in Germany, where under 5% of households are equipped already. I mentioned Norway, which has a really high penetration of heat pumps that really helps bring power demand to the upside. On the other hand, we have for transport lower EV sales in 24 compared to 23. It really shows a confidence crisis in the automotive industry, how consumers are holding back and delaying investments in new technology that they don't necessarily understand or envy. So yeah, that's going to be interesting to monitor in 25. But short-term wise, it's not looking super dynamic on the demand side. Now, if we have a look about what could happen on the supply side, well, we've been deploying a lot of renewables. It's gonna happen until the end of the decade and even grow faster. One symptom of having more renewables is more intermittency in terms of amplitude. So that means that sometimes you have higher generation. That's what the grid actually needs. And one symptom of that is having negative prices. So to disincentivize electricity producers to produce energy, they have to pay to produce energy. So that's one symptom of it. And it's likely to grow again in 25. Maybe not in the number of hours, but we're still likely to see a pretty deep negative prices. Mainly thanks to solar, which is slowly showing a saturation of the market, as basically during the day there's almost too much solar generation produced, and you still need the backup gas-fired assets in the evening or during the night to produce power. So without more flexibility on supply and demand side, we won't be able to harness fully the potential that renewables offer. You want to offset some of the solar generation to the evening. You want to put more load during the solar hours instead of the evening. So yeah, it's going to come from both sides, but it's not developing yet. Storage capacity is for now insufficient, but the development speed are much faster than for wind, for instance. It takes less than a year, for instance, for storage to come online. So there is hope, but we could see an oversupply in terms of renewables and reach the limit of what they can actually provide in terms of pressuring spot prices. If we look at the curve, calendar prices, we see that in Europe, well, gas really remains the key anchor, like combined with carbon, obviously. So the gray line you can see on the left chart is the marginal cost of a gas asset, let's say. And this is reshaping power prices until the end of the decade. We see a decline, and later on a stabilization. Further from 2030, we haven't much a view on, or the market doesn't have a clear view on what could unfold. On the other hand, you have really discounted French prices. Again, it's likely to be EDF selling lots of volumes on the market. And it's actually lower prices than what they initially intended to sell in the post-ARENH deal with the government. So there's a bigger, greater incentive to hedge volumes on the market compared to directly with EDF. Towards the end of the decade, we see a new convergence where the dust settles finally around the gas market. Things loosen up, and we see power prices trading closer. And for those prices are still very much linked to long-term uncertainties, both on demand and supply side. We could see a fallback on renewables deployment if capture rates are too low, capture prices are too low. It's really gonna be interesting this year to see how a new project come online and what the impact on the spot prices will be. I'm gonna quickly conclude on the emission side, which has been really interesting, especially at the end of the year, where we saw a Christmas rally due to two reasons mainly. First one being we had no supply in the auctions, which was planned and known by the market, but still it reacted to the upside. We had the end of Russian gas through Ukraine, which pushed gas price higher and therefore carbon price higher, because we still see a pretty strong correlation between gas and carbon prices, and it's been increasing over Q4, and it's so high now that you can even believe that it could loosen up a bit in the next few weeks. On the short term, it's also linked to the power market, but because we needed more generation from dispatchable power sources, we generated more power from coal and gas assets in November, December compared to last year. So that really boosted short-term emissions, so more demand for emissions. But it's still good to keep in mind that it's shown on the right chart. There's an economic advantage for coal assets over gas plants now, given how more pricey gas is compared to coal. But the potential for switching between coal and gas is increasingly limited because we have fewer coal plants that are still online. And there's also more retirements to come in 25, as I said, in Germany. And the most producing coal asset in Germany is likely to be decommissioned, or put on the reserve in Germany in 25. If we look a bit further at the end of the decade, the first thing on the left is about Repower EU, which has a package to finance the energy transition through revenues from carbon tax. So some volumes were front-loaded in order to raise as much as 20 billion euros. But given the market prices we've seen, the sales is 1 billion euro short as of today. So maybe the European Parliament the European Commission is gonna act on that to actually meet this target and have more volumes. But it's still good to keep in mind that the balance is still set to tighten. So we're gonna see higher demand from the shipping sector, which is gradually entering the market this year and next year. And we also have the aviation sector, which auctions are gonna be reduced despite the market growth. So that might even increase the demand from that sector even more. And lastly, we had the our last point is on the speculator side, because carbon is a speculative market. There are lots of hedge funds, people managing money who are invested in this market. And since the end of September, we've seen a flattening in their positioning. We've seen a strong decrease in their short position, which can be seen in red, an increase in long positions, which can be seen in green. So overall, they've increased their bullish bet, betting on higher prices. So that raises the question of, are they actually just betting on the short-term developments that was pretty profitable in Q4 24, or are they actually getting ready for what's coming later in the decade, starting 26, when the balance is going to tighten? So it's a question that remains unanswered, but what's still true is that they have the ability to enhance the volatility on the carbon markets, push price higher than it maybe should be or lower, and they are likely to continue shaping the carbon prices on the short term. And as the year unfolds, and as we get closer to a short balance on the in 26. So lots of you answered a 70 to 80 euros target. That's something we believe internally. We've revised the focused upward given the developments late 24, but we still believe that a price in the 70, 80 euro range could be the price for the end of 25. There are some uncertainties, obviously, on the short term, given power generation and renewables output. But long-term wise, it's set to increase. It's designed to increase, basically. Thank you for your attention. Any question from the chat, Julien?
Thanks a lot, Luc. Yeah, we have many questions in the chat, so thanks to our participants for making this session very dynamic. We won't be able to answer everything, but we will do it afterwards. So one question for you to start regarding French nukes. So we have recently seen a huge increase in the modulation, the intraday modulation of French nuclear plants. In November, on the 24th, 6 of them stopped completely because of economic, strategical reasons. What is your view on this point? Is it a phenomenon that will go on in the coming months and years, and what would be the impact on prices?
Well, since it's pretty convenient for EDF to put that reason forward, because since the 24th of November, we've seen really high demand in France. So there's not a real need to modulate for now. We have gas is marginal in France, so they're really trying to maximize their output and their revenue. It makes sense. On what could happen, for instance, this spring, it's the modulation has been prepared for on EDF side, and I don't think it's gonna decrease that significantly unless there is new evidence that they could pose a new issue in terms of corrosion, which is an hypothesis right now. And if there was lower modulation, we could see lower prices as well, because the market's just going to be even more oversupplied. Yeah.
So one question regarding Italy, and we have seen in your charts that Italian power prices are trading much above the rest of the continent or Western Europe. So what is the main reason for this premium?
Italy is a net importer of power, so it's importing power from France, Austria, and basically because it's in the way it's producing power is really dependent on gas generation, which is for now expensive. We have high gas and high carbon prices, and renewables are not deployed enough to pressure significantly and throughout time in Italy. Wind is not pushing prices in winter. Solar can have an effect in the south of Italy in summer, but for now it's still not super significant.
Okay, thanks. One last question regarding renewables and the capture rates. They have decreased a lot last year. So how do you see these capture rates evolving in the next few years?
Well, it's if you remember, I showed the chart with the generation from wind and solar that could come online, and the issue is really that we're gonna have more generation of cheap electricity, virtually at €0 of marginal cost at the same time everywhere in Europe. So capture rates are therefore likely to decrease even more, especially because, for instance, if I take solar, everyone is going to produce at the same hour during the day. In the evening, we're still going to have gas, which is going to bring the average higher throughout the day. But the actual recovered price for solar generators during the day is still going to be super low. So more solar and wind generation is only going to bring capture rates lower until we see more flex, until we see more batteries, for instance.
Okay, thank you, Luc, for your
Welcome.
answers. So it's time to move on to the end of this session. So be informed that the next webinar session will take place at the end of February, and it will be a dedicated session about the EU ETS2 with some key experts here at ENGIE Global Energy Management and Sales. So before I close the session, we would like you to answer a very short satisfaction survey that will be published in a few seconds on the screen. So thanks for your feedback, which is always valuable to us. And thanks to those who took a few seconds to answer the survey and stay until the end of this session. So it's no time for me to close the session. I hope you enjoyed it. As a reminder, the slides and the replay of the session will be available on our EnergyScan platform. And you will also receive an email with a link towards the document and the replay in the coming hours or tomorrow at the latest. So thanks again for your attention and all your questions, and see you soon on our EnergyScan platform. Goodbye.